Once again, let me take this opportunity to welcome you all to our this semester for 2024. We are doing, my name is Daniel Motiso. I do cover the following subjects: financial management, advanced financial management. We do management accounting, advanced management accounting. We have taxations and we do both taxations. And also when you go to the foundation level, I normally also look at quantitative analysis and economics in that regard. So today I just want to connect our knowledge from what we were able to do at the lower level. In this case, we are looking at a topic which was existing under the financial management intermediates called the capital budgeting decisions. And if you are able to attend my classes, you could be able to tell me that the areas that you are going to be looking at here are familiar with what we did at the intermediate level regarding to the advanced capital budgeting techniques. And in this case, we just need to be understanding, because I know very well some of the students can be able to look at what is a capital, right? Sometimes we normally talk about the difference between the current asset and the current liabilities. What is a budget? And some of the students might be able to tell you a budget is it is something that is going to be showing a forecasting. It is normally tries to look on the the budget is something that an organization normally sets so that they can be able to work on it in the near future or under the current certain financial year. So the decisions are the ones that you're going to be looking at on the capital budgeting decision. And we are saying that it normally refers to the investment decisions of the firm. In this case, we are saying the decisions on how the firm should invest in the long-term projects so as to maximize the shareholders' wealth as to the value of the firm. So such decisions may include: one, expansion of the existing projects, replacement decisions. We also have undertaking a new project or product line. We also have things like the research and development activities. Those are some of the things. So there are some of the decisions that we can be able to come up with to maximize the shareholders' wealth. But we are saying, as we are able to look on such achievements, there are some of the challenges that we can be able to come across when it comes to the decisions in the real world. And one is the uncertainty in the expected economic life of the project. Secondly, we normally look on the uncertainty in the expected future cash flows, which are always based on the forecasted values. The other thing that we are looking here is all about inadequate information. And we are saying that it is practically impossible to gather the relevant information about our projects when in advance. And then number three, or the last one we are talking of, uncertainty in the cost of the capital. And in this case, I know very well some of you who are able to do financial management last semester, we used to like so much the cost of capital. And here we are going to be looking on the firm's WACC, which is it normally has some fundamental assumptions which may affect the project. Now, when you look on the these uncertainties, you can bear with me that the cost of capital, we normally have to be looking on two things. What are some of the securities which are used by organizations to finance their projects? And that is where we're going to be doing our analysis on the WACC. Then we have a concept whereby we are going to be dealing with WMCC, whereby we are looking on, we have new projects which require new funds. Are we going to be financing it as an organization? Just give me a minute. I pick a phone here, please. Let's look on the type of investment projects, because when you're looking on investments, and I know most of you have done their own investments, whether with the buying the securities with the relevant companies or buying the bonds from the CBK, what I can be able to know is that there must be some risk which is basically involved. And because we want to do an investment, and that is how we are going to be enjoying the aspect of the portfolio. I know very well that we don't want to put our money in one basket. We normally like to diversify the risk. And in that case, when you are doing the portfolio, we are going to be looking on the combination of the assets. And these assets should be 2 or more. So in that regard, we need to be able to understand that the mutually exclusive projects, these are just alternative projects which always compete with one another and cannot be undertaken together. So when, for example, we are going to be investing, and I know that whether we have invested or we have that target, we have heard about MMF. We have also heard about infrastructure bonds, which normally are tax-free. We have already heard about the fixed deposit accounts. I know that we have done a lot of investment. There are those people who normally say, I'm not going to be investing with I don't want to put my money in the savings account in a bank. I need my money to be giving me some returns. And those are the people who today are doing so well in terms of getting interest. Saizi wanangojea pesa as we speak right now. They are waiting for money and so on and so forth. So in this case, because that is the aspect of the portfolio theory, mimi ndio maana sionangi advanced financial management ikiwa ngumu. It is based on the actual. It is it is a practical thing. So there is no any way we are going to be saying that advanced management in government and so on. So no. It is something that is practical, and that is where you normally find some students who think about illusion. They will be able to find it hard to pass advanced management accounting. Just be able to apply this knowledge directly to what you are dealing with today, and then you will not be able to find it hard. Now, we have independent projects, and we are saying these are not related in any way, and they cannot be undertaken subject to their profitability and availability of cash. We have complementary, which are dependent projects, and these are the projects we rely on each other on survival, and they must be undertaken together. That is, the selection of one of the complementary projects automatically leads to the selection of the others, where the finished goods of one project becomes the raw materials of another project. We normally have divisible and indivisible projects, and we are saying divisible projects, and these are the things that we're going to, by the way, this knowledge of divisible and divisible, as we finalize our topic, we are going to be discussing about it as we cover the subtopic of the capital rationing about the divisible and divisible projects. And the knowledge that we need to understand is what is the meaning of the divisible projects. And we are saying divisible projects are projects that can be scaled down towards downwards, hence implemented partially. What do we mean by that? It means if for example, Meshach has 200,000 and he wants to undertake 4 projects. Uko na ka project ka A, B, C, D. Ka A kanataka 20, kengine kanataka 50, kengine 60 namna hiyo. What it is very important is to understand that because you are going to be using profitability index, and you know it, you have done it, and under the intermediate level, the profitability index is going to be telling us which is the project which is giving you the highest return, and what is the initial outlay of that project. So it is good. We are going to be investing based on based on your ranking. Based on your ranking, that is how you normally invest on those projects. You invest from the ones which are the best to the least ones. So pesa mingi utaweka kwa ile project inakupea pesa mingi compared to as you scale down your money. So in this case, that is where we are saying, if a project, for example, umefika kama project D, ukapata initial outlay yake ni 50, but umebakisha kama 20. That is what we talk about partially. But when it comes to the divisible projects, we mean that these are the projects which cannot be scaled down, hence can be undertaken 100% of the initial outflow, the initial outlay which is available. Now, in this case, umejipata uko na projects pale umerank. Uko na project inataka 100,000, uko na ingine inataka 50, uko na ingine. So, umekuja ukainvest kwa project A na 100,000, project B 50, project C inataka 50, but for instance umebakisha 25. Let me talk about an initial capital of 175,000. So unataka umebakisha 25, you cannot be able to invest on the third project because you are yet to meet the initial outlay of that project. That is the difference between the two, and it is very crucial when you are doing the capital rationing, which was tested in 2021 at your level. Now, what are some of the benefits of the capital budgeting? Investment decision must be carefully planned and made of the following reasons. One, they involve significant amount of cash flow, hence can lead to heavy losses in cash in case of failure. Secondly, such decisions are highly irreversible or can only be reversed at substantial losses. The decisions normally affect all the departments of the company, which may influence the operations of the entire firm negatively in case of failure. The other one, it may affect the morale of all the employees of the firm in case of failure due to the inputs made by each one of them in the initial implementation stage. Then the last one, it may affect the overall risk of the firm due to high cash outflows involved in its implementation case of failure. Now, what are some of the characteristics of a good investment appraisal techniques? It must use discounted cash flows and not accounting profits. So what is the accounting profits? Because we are saying the accounting profits can easily be manipulated since they include non-cash items such as the provisions and depreciations. In addition, accounting profits are also affected by accounting standards used and accounting policy applied. The next one, it should consider the time value of money by discounting the cash flows. Remember when we talked about the time value of money, it is a determination. We talked about the determination of the future and the present of the expected cash flows. Now, it is used, it is normally, it should, we have said, it should use cash flows relating to the entire life of the projects when evaluating the project's viability. It should rank the projects according to their true profitability. It should be consistent with the shareholders' main objective of maximizing when cash flows are used and when such cash flows are discounted. And it should be consistent with value additivity principle, where different projects can be combined to get the total increase in the value of the firm. Now, we have some of the investment appraisal techniques, and we might not be able to cover all of them as we continue to do our parts. Most of them, they are not tested here. So it means that we are not going to be checking all of them. So one, we have not discounted cash flow techniques, which we call them traditional techniques. The first one, which is subdivided into the accounting rate of return, and then we normally have the payback period. Secondly, we normally have discounting cash flow techniques, and which are modern techniques. We normally have the net present value, which is mostly powerful. We have the internal rate of return, which we are going to be checking, profitability index, discounted payback period, and then we have the modified internal rate of return. I know all of these, we have done them when we were doing section 3. What are some of the discounted cash flows? And I'm not going to be checking on them. Just allow me to go to the important areas. And the important areas is that I'm going to be looking on, even if an examiner is very silent, he has told us to advise the organization which method am I supposed to use. Now, in this case, it means, allow me to start with the modern techniques, and the most powerful method which we are going to be repeating to what we did in section 3 should be the net present values. The net present values. Let me look on the notes for the net present value, please. I shall be able to come back to the payback period, please. So when you look on the net present values, we have said it is the difference between the difference between the present value of the cash inflows and the present value of the cash outflows. And that is the difference between the inflows and the initial outlay. So the cash flows are normally discounted using the firm's cost of capital, that is the WACC. And down there we have said, because I have to be giving you some write-ups there, I need you to have your book and a book and a pen somewhere where you can be able to write. I will be able to come back to that. Now, the working capital invested is an initial outlay, and it is expected to be maintained throughout the project's useful life. And upon termination, it will be recovered or released as the terminal cash flow. Now, what are some of the acceptance rules? Because I will be able to discuss this much under our advanced capital budgeting decisions, whether we are looking on the investment appraisal techniques. Now, as we look on some decisions which we normally make here, where we are discussing about the techniques of handling risk, the examiner will be able to ask you, because there are different techniques which are available for handling risk under the investment decisions, Remember, we normally have decision theory, simulation analysis, sensitivity analysis. We have scenario analysis. We have the risk-adjusted discounted rate. Then we have certainty equivalent method. The last one is basically the utility analysis. So now, when you look on all these, they are going to be asking you at the end of the question to compute the NPV. So that is why I've said it is the most powerful method. It is the most powerful technique which is used in measuring risk. And it is very important for you to understand the stages which are basically used when you are computing the NPV. What I was able to receive through my call is that one of my colleagues has passed away. So I'm just going to be covering I just be able to cover the a bit of the how to compute the NPV, and will be able to allow me to follow up with that information, because I think but it is one of the people who I was able to supervise. So I will just be able to catch up on that later on. So today we'll not be able to do much. Now, let me just share my board so that we can be able to look on the formula, or what are some of the steps which you can be able to use when you are computing the NPV. But before we reach there, it is very important to understand what is the acceptance rule under the NPV. And a project with a positive NPV is basically accepted, while a project with a negative NPV is rejected. A project with a zero NPV will be or may be accepted. Then the last one we are saying, the higher the NPV, the better the projects. Down there, because I have already shared these notes with you, you will be able to see on pros and cons of all of this. And you just need to summarize or memorize them. They are always tested there. I don't want you to find hard time when you are doing your exam. So let me share my board so that I can first give you what is the formula in the computation of the NPV. Thereafter, we shall be able to discuss the way forward. Okay. Can you be able to see my board right now? You'll be able to see it. Just type there, yes. Just type there, yes, I can be able to see it. We are able to see it. It's very important to know. Now, remember, the topic which we are covering today is normally called the advanced capital budgeting decision. And one of the key things which you want to look at it here, I can see you're not seeing where I'm writing. Let me see where you can be able to see it. Let's see, 1 minute. Correct. Very good. We are doing the advanced capital budgeting decisions, and I just want to look at how can we be able to get our NPV. We have said it is the difference. The NPV, it is the difference between the cash inflows and the cash outflows. That is what we have said. So what are some of the methods, or what are some of the criteria which we normally use when we are computing the NPV? One of the stages that we have to use, we have to be calculating our initial trade. Right? We have our initial trade there. Correct? So when you're computing your NPV, just come up with our 2 columns here. So we have Kenyan shillings there, and then we have the Kenyan shillings there. We might be discussing about the analysis that we're going to be doing here. We might be discussing about a project, right? Or a machine. So in this regard, let us check on it when we are dealing with a machine. So what am I going to be taking first as I approach my questions? The first thing that you need to do is by taking the cost of the machine. The cost of the machine stroke the project. So how much is the cost of the machine or the project? You put it there. The next thing that you have to be checking on, it is you normally add some incidental costs. What are some of the incidental costs which you're supposed to be adding? One should be installation costs. You're supposed to be factoring the installation costs. You put it here. The second thing is the commissioning costs. Commissioning. What are some of the commissioning costs? You put them there. We have testing costs. Some testing costs to Naikapo. Now, at the end of the day, you're supposed to be getting that summation and you put it here. Get that summation and you put down there. So what am I going to get at the end of the day? You're supposed to be getting something called the total cost of the machine. What is the total cost of the machine, right? You're supposed to be taking the cost of the machine. You take the cost of the machine plus the incidental costs. You get the total cost of the machine. You can see there's some areas which you cannot be able to see. 1 minute. Right. This is our first day, so no problem. Okay. I know you can be able to see everything. Okay, that is okay now. So after you get the total cost of the machine, which you have already taken the cost of the machine of the project, plus the incidental cost, what else are you supposed to be doing? You normally find in other questions, the examiner is discussing about replacement of the machine, right? I know these are the problems that you are able to check from the previous units. So when we are looking on the disposal, is what now we are going to be factoring here, if it is existing in the question. If it doesn't, then you don't need to include them here. So in that case, we just come and you say less the disposal value. We are going to let the disposal value of old machine. The disposal value of the old machine, I put it here. Right? The disposal value of that machine, I put it there. Then we need to get, we have to be checking on something called the tax on gain, stock loss on disposal. So what am I supposed to be checking here? The first thing that you're supposed to be taking on, it is the disposal value of the machine. The disposal value of the machine, you normally factor it there first. Later on, we have to be checking on the net present value. The net book value, sorry, of the old machine. I know very well you know how to calculate the net book value. And if you don't know, we shall be able to see that computation in our, we shall be able to see that under our computation. So in this case, we let them here. So if you get a positive, the positive amount, this is what we are talking about, the tax on gain, stock loss on disposal. So you take this and then you multiply by the tax rates, right? The value which you have gotten here, it might be positive, it might be negative, right? So in this case, what you multiply by the tax rate, say for example, you got a positive figure. So you're going to be adding it here on your second column. If you got a negative figure, you're going to be subtracting it there. Right? So after that, you're going to be doing your summation there, right? You're going to be doing your summation down there. Is everything okay? Let me know. Is everything okay? So in this case, after you take the total cost plus you less the disposal value, sorry, you normally take the total cost of the machine, you less the disposal value of the old machine, then you add the tax on gains or loss of disposal. What you're supposed to be getting down here should be the net cost. The net cost of the machine. The net cost of the machine, you get it there. Then what you're supposed to be now completing on this is that we normally add investment in working capital. I know very well that you know how do we normally compute the working capital? We know very well we normally take the current asset minus the current liabilities, right? You put there. Then at the end of the day, what you're supposed to be getting, we normally call it the initial trade. The initial trade. But in most of the question you might find, this area is not available, right? From here up to that point. It might not be available in most of the questions. Why? Because we are discussing about the disposal of the old machine. If it is not there, then it is not necessarily you use it when you are doing your computation. So in this regard, it means only applicable when disposing a machine. It is only applicable when disposing a machine. If we are not disposing any machine, it means it is not applicable. Now, from that one, let us look on the next stage, which we normally use, number 2. We are discussing about the annual net cash flows. The annual net cash flows is an area where we have to be looking at. It is an area where you have to be understanding very crucial things here, whereby there is an aspect of annuities and lump sums. Na hizi ni vitu umesoma pale chini. So we have to be looking at, let me see whether you see it, yes. So here we have to be looking on the annuity and lump sums. So I know very well that we have done some investments. We have done some investments. Na umeenda umewekelea pesa yako kwa a fixed deposit account, 100,000. Do you know under a specific period, you might be getting the similar amount? For example, nimewekelea pesa yangu every year, when they are paying their interest, every year na wananipeanga 50,000 on my investment, right? But now, when I look on the lump sum, it means, kuna watu wanasema, wakati hii pesa unalipa, roll it to the principal amount. So kama nilikuwa nimeinvest, for example, 100,000, the next interest yenye watafanya na 150. These interest which I'm going to be getting, tuseme hii nimepata 50,000, hii nimepata 70,000, right? These interests are not the same. They are not similar, right? So when we discuss about the annuity, it means the cash flows are similar. When we discuss about the lump sum, it means the cash flows are not similar. Hazifanani, right? So let me apply the concept of the annuity. And then I look at, my project is taking 1 to 5 years. My project is taking 1 to 5 years, right? That is my project now. It's taking 1 to 5 years. So 1 to 5, it means this is an annuity, right? This is what we talk about the annuity. It means year 1, year 2, year 3, year 4, year 5, you are going to be receiving the same cash flow, right? That is the aspect of the annuity. But when you talk about the lump sum, it means ningeandika namna hii. If I was dealing with the lump sum, it means the cash flows are not the same. So ningeandika namna hii. You see something looking like this? This is what I could have done. But let me just go with the aspect of the annuity. Now, this is very crucial because how am I going to be getting the annual net cash flows? I'm going to be starting with the sales if they are not provided in the question. We put them here, right? We less the variable costs. So the variable cost, we put them there, correct? So after the variable costs, or sometimes you might be discussing about the cost of sales. So what am I going to be getting down there? I'm going to be getting something called contribution. We are going to be getting the contribution. So what is our contribution here? Stroke profits. So our contribution, we are going to be putting them here. After you get your contribution, let us less our fixed costs. Less our fixed cost, we put it there. What you're going to be getting down there, we are going to be getting something called the earnings before depreciation and taxes. We get them there. And because mimi siyuko hapa kushinda nikikuandikia the long method, right? I know that you understand there is a long method and there is always a short method when you are doing this computation, right? There is a long method and there is a short method when you are doing these computations. But allow me first to less our taxes, right? Let us less our tax. We less our tax, right? After we less our tax, sometimes we normally add something called depreciation tax sheets. Depreciation tax sheets is the easiest methods. So how do we normally get the depreciation tax sheet? You normally take the cost of the machine, the cost of machine, we let the scrap value, we divide by the number of years. All of these, we multiply by tax rates. Here you add it there. You add it there. Then what you're supposed to be getting down here is what we are calling it the annual net cash flows. Whatever you are getting down here, it is what we know is normally called the annual net cash flows. Right? Is what you're going to be getting down there. All right, I'm receiving a lot of calls. Let me just finish with the third stage. So number three here, we normally discuss about the terminal cash flows. Aina tofauti sana with whatever we have been doing. So here we take your Kenya shillings. So what are you supposed to be factoring first? Do we have the scrap value of new machine? What is our scrap value of the new machine? Unaeka hapo. Then you normally less the scrap value of old machine. The scrap value of the old machine. Then we normally add investments in working capital. Investment in the working capital, we put it down there, right? So what we're going to be getting down here is what we are calling the terminal cash flows. The terminal cash flows. You will put it down there. The terminal cash flows is what you're going to be getting down there. So this is the stage which you normally use when you are computing your NPV. I know that there is the long way of the computation of the annual net cash flows. Mimi napendanga the short way because hata ukiangalia vizuri haitachokesha mwanafunzi to master how am I supposed to be calculating the annual net cash flows? How am I supposed to be calculating the annual net cash flows? Now, because some things are coming too fast and quick, I will be able to request that to stop at that point. I will just be able to share a video regarding to my first topic, right? For revision. It's not about for our syllabus. That one is for you to revise. So that the next time when you are coming in, I will just be able to start with the illustrations. I'll just be able to come up with illustrations. And then also we look on other investment appraisal techniques as we finalize on it so that we can check on the techniques of earned risk, which are very mostly examinable. So as I finalize on this, I just want to stop at that point. That was not my plan, by the way. I wanted us today I had a lot of content to teach you today, but things normally happens. So let me first handle what is coming now. I hope mutanielewa today.